Nike just closed its 2026 fiscal year, and on the surface, almost nothing happened. Revenue was flat. Gross margin ticked up. Operating income actually rose. If you stopped at the income statement, you would call this a stable year. But one line in the cash flow statement tells a different story. Operating cash flow fell more than 22%. Net income fell only 3.4%. That gap is not a rounding error, it's a signal. And when you follow it back through the balance sheet, it leads to a single number that defines this entire filing. Let's walk through the full year, segment by segment, and find out what actually changed. One line on the company. Nike designs and sells athletic footwear, apparel, and equipment, and in fiscal 2026, that business generated $46.4 billion of revenue across 4 product lines. Everything here comes from the 10-K for the fiscal year ended the 31st of May, 2026, filed on the 15th of July. That filing carries 3 reported years of income statement and cash flow data, so we can put this year in context rather than looking at it in isolation. 2 8-Ks preceded it, preliminary fourth quarter results on the 23rd of June, and the full year release on the 30th. There is no earnings call transcript in this data, so there's no management commentary and no guidance here, only filed figures. Start with the headline. Revenue of $46.4 billion, up 0.2%, $89 million of growth on a $46 billion base. That is flat in every practical sense. Gross profit came in at $19.91 billion, up 0.6%, slightly faster than sales because cost of revenue actually fell from $26.52 billion to $26.49 billion. Operating income reached $3.8 billion, up 2.6%. So through the operating line, everything moves in the right direction, just barely. Then it inverts. Net income fell 3.4% to $3.11 billion, and diluted earnings per share fell 2.8% to $2.10. Profit went down while operating profit went up. That contradiction has a specific cause. Here is the real story of the year. Compare operating cash flow to net income. How much reported profit actually arrived as cash? Fiscal 2024, $7.43 billion of operating cash flow on $5.7 billion of net income. A conversion ratio of 130%. Fiscal 2025, $3.7 billion of cash on $3.22 billion of profit, 115%. Fiscal 2026, $2.87 billion of cash on $3.11 billion of profit, 92%. For the first time in this 3-year window, the ratio broke below 1. Operating cash flow fell $830 million, while net income fell only $111 million. That divergence has to come from somewhere on the balance sheet. It comes from receivables. Accounts receivable rose to $5.93 billion at the end of May 2026, from $4.72 billion a year earlier, a build of $1.21 billion, up 25.7%, against revenue that grew $89 million, or 0.2%. Receivables grew more than 100 times faster than sales. Mechanically, a receivable is revenue you have booked but not yet collected. When that balance swells while sales stand still, cash leaves the operating statement even though profit doesn't move. That $1.21 billion build more than accounts for the $830 million drop in operating cash flow. The filing gives no days sales outstanding detail, so we can't name the cause. Extended terms, channel loading, slower collection all fit the shape. But the direction is unambiguous, and it is the single most important item in this report. Now, the profit decline. Cleaner than it looks. Pre-tax income was $3.9 billion versus $3.885 billion, up $15 million. Before tax, earnings actually grew. Income tax rose to $792 million from $666 million, an effective rate of roughly 20.3% against 17.1% last year. Pre-tax up $15 million, net income down $111 million. The entire profit decline is tax, not operations. There's no below-the-line distortion, no one-off gain, no discontinued operations disclosed, and pre-tax income sits just $103 million above operating income, consistent with modest non-operating income. Diluted EPS fell less than net income, minus 2.8 against minus 3.4, because diluted shares drifted down from 1.488 billion to 1.481 billion. Recurring earnings power is marginally better than the EPS line suggests, and last year's 17% tax rate was the anomaly, not this year's. Nike reports revenue across 4 product lines: footwear, $30.54 billion, 65.8% of the total, down 1.4%. Apparel, $13.5 billion, 29.1%, up 3.5%. Sporting equipment, $2.22 billion, 4.8%, down 0.1%, unchanged. And a small other category at $143 million, 0.3% of revenue, up 93% off a $74 million base, a big percentage on a number too small to matter. So a flat top line is really 2 lines pulling against each other. Apparel added $452 million. Footwear lost $429 million. That's the offset, almost exactly. The largest segment is shrinking, the second largest is carrying the group. Footwear deserves its own slide because at 65.8% of revenue, it effectively is the company. $30.54 billion this year, down from $30.97 billion, a decline of $429 million, or 1.4%. That matters for 2 reasons. First, concentration. When 2/3 of revenue declines, everything else has to work harder just to hold the line, and this year, everything else barely managed it. Second, mix. Footwear is the franchise, the brand engine, the category the company is known for. 1.4% is not a collapse, but it is not stabilization either. It is continued erosion at the center of the business while the perimeter compensates. The filing gives us the number, not the reason, and there's no earnings call in this data to explain it. Apparel is doing the work. $13.5 billion, up 3.5%, or $452 million, enough to cover the footwear decline with $23 million to spare. It now represents 29.1% of revenue, up from about 28%. That mix shift is the closest thing to a growth story in this filing. Sporting equipment is flat, $2.22 billion, down $3 million, 0.1%. And the other line at $143 million stays immaterial no matter what its percentage says, so rank them. Apparel is the biggest grower, in dollars and in percent. Footwear is the biggest decliner in dollars, and the group grew $89 million in total, which is what happens when your growth engine is 29% of the business and your drag is 66%. Zoom out, because a flat year only means something against what came before. Revenue in fiscal 2024 was $51.36 billion. In fiscal 2025, it fell to $46.31 billion, a drop of $5.05 billion, close to 10%. Fiscal 2026, $46.4 billion. The shape is a large step down, then a flat line. This year stabilizes the top line. It does not begin to reverse the decline. The company is holding the level it fell to, not climbing back. Cost of revenue tells the same story. $28.48 billion, then $26.52, then $26.49. And SG&A, $16.58 billion, then $16.09, then $16.11. Costs came down with sales, and now everything has stopped moving. The margin trend is where the reset is clearest. Gross margin, 44.6% in fiscal 2024, 42.7% in 2025, 42.9% in 2026. Up 0.2 this year, still 1.7 points below 2 years ago. Operating margin, 12.3%, then 8.0%, then 8.2%. Up 0.2, but 4.1 points below the 2024 level. Net margin went the other way, 11.1%, then 7.0%, then 6.7%, down 0.3 because of the tax step-up. And returns kept falling. Return on equity was 39.5% in fiscal 2024, 24.4% in 2025. 5, 20.9 in 2026. Lower again, even though the equity base grew 12.5%. Return on assets slipped to 8.1 from 8.8. Margins stabilized. Returns did not. Walk the bridge for this year. Revenue down to net income. Start with 46.4 billion of revenue. Subtract cost of revenue of 26.49 billion, gross profit of 19.91 billion, a 42.9% gross margin. Cost of revenue fell 32 million, while revenue rose 89 million, and that alone is the 0.2 of a point of gross margin gain. Then subtract SG&A of 16.11 billion, up just 26 million. Holding operating expense flat while gross profit rose 121 million is what delivered operating income of 3.8 billion, up 95 million, at an 8.2% operating margin. Read that carefully. The entire operating improvement is cost discipline, not demand. $95 million of gain on a $46 billion business, real and thin. Then tax takes it back and net income lands at 3.11 billion, a 6.7% net margin. The cash statement in full across 3 years. Operating cash flow, 7.43 billion in fiscal 2024, 3.7 billion in 2025, 2.87 billion in 2026. That's not a step down, it's a slide. Minus 22.4% this year on top of a 50% drop the year before. Capital expenditure moved the other way. 812 million, then 430 million, and back up to 684 million this year, up 59%. Less cash in, more cash out. Free cash flow, operating cash flow minus capex, was 6.62 billion in 2024, 3.27 billion in 2025, and 2.18 billion in 2026. Down 33% this year, down 2/3 over 2 years. Depreciation and amortization is stable at 747 million versus 775 and 796, so no non-cash swing is masking this. The deterioration is working capital. Watch what that does to capital returns. Dividends paid rose again, 2.17 billion in fiscal 2024, 2.3 billion in 2025, 2.41 billion in 2026. Buybacks went the other way, violently. 4.25 billion, then 2.99 billion, then 146 million this year, a 95% cut. Now set that against free cash flow of 2.18 billion. Dividends alone were 2.41 billion. The dividend exceeded free cash flow by roughly $223 million and consumed about 84% of operating cash flow before capex even landed. So the distribution is funded partly off the balance sheet, and the flexible part of the return, the buyback, was switched off almost entirely. Total financing outflow narrowed to 2.29 billion from 5.82 billion. That isn't deleveraging discipline, that's the buyback disappearing. Against all that, the balance sheet is genuinely a source of strength. Total assets grew 5% to $38.41 billion. Long-term debt fell to 5.94 billion from 7.96 billion, a 2.02 billion reduction. Debt to equity eased to 1.58 times from 1.77. Equity rose 12.5% to 14.87 billion, helped by retained earnings improving to minus 155 million from minus 727 million. Retained earnings are still negative. The legacy of years of large buybacks, not distress, but it does cap distribution flexibility. Cash held at 7.56 billion, more than the entire long-term debt balance. 2 cautions. Current liabilities jumped to 12.55 billion from 10.57, a 2 billion build mirroring the long-term debt decline, consistent with maturities moving current rather than debt being repaid. And the current ratio slipped to 1.96 times from 2.21. Operating lease obligations aren't in this data, so lease-adjusted net debt can't be assessed. The signal set around this filing is thin. Insider activity. 0 open market buys, 0 open market sells, an empty transaction list. No directors, officers, or 10% owners appear as transacting parties in the window. That is not bearish and not bullish. It's an absence of reported transactions and should be read as exactly that. The event's flow is dominated by one item. On the 23rd of June, Nike announced a CFO transition. David Denton, formerly CFO of Pfizer and Lowe's, becomes Executive Vice President and Chief Financial Officer effective the 16th of August 2026. Matthew Friend, the outgoing CFO, advises before departing in September. That same release carried preliminary fourth-quarter figures. A week later came the full-year results release, then the 10K on the 15th of July. A finance leadership handover landing alongside a $1.2 billion receivables build is worth noting. The filing gives no indication the two are connected. So what matters going into fiscal 2027? Four things. 1. Does the receivables build unwind? If that $1.21 billion reverses, cash conversion returns toward 1 times, and this year reads as timing. If it doesn't, it reads as structural. 2. Does the 0.2 of a point of gross margin gain hold or reverse on promotional activity? 42.9% is stabilization, not recovery. The 2024 level was 44.6. 3. How does the dividend get covered? At $2.41 billion and rising, against free cash flow of $2.18 billion and falling, the gap has to close from one side or the other. Whether buybacks resume is the tell. 4. Execution through the CFO transition on the 16th of August. 3 ways it can go. Bear. Footwear declines steepen, working capital stays inflated, free cash flow stays below the dividend. Base. Revenue flat, margins hold near 42.9 and 8.2. Cash conversion normalizes toward last year. Bull. Apparel momentum broadens, receivables release cash, and the gap back to 2024 margins starts to close. No guidance is available to anchor any of it. One line to take away. Fiscal 2026 is stabilization on the income statement and deterioration in cash, earnings holding a reset floor while becoming less cash-backed. Revenue flat. Operating income up $95 million on cost discipline. Net income down purely on tax. But operating cash flow down 22%, cash conversion below 1 times for the first time in 3 years, a dividend larger than free cash flow, and a buyback cut 95% to fund the difference. The balance sheet is strong and getting stronger. The income statement is flat and holding. The cash statement is the one that moved. And cash is the harder number. That's the year, straight from the filing.